Good day. My name is Louis Rousseau, and I'm a portfolio manager with AdviceWorks Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how AdviceWorks sees the way forward. The negotiations about the post-Brexit trade deal between Britain and the European Union are headed for a cliffhanger ending. The two parties are deadlocked on two key matters: EU fishing rights in British waters and competition rules. Unless an agreement is reached before the end of December, free passage across common borders and duty-free trade will cease. Britain stands to lose more if an agreement isn't reached, as nearly half of its exports currently go to the EU. As of last night, more than 69 million people have been infected with the coronavirus, and over 1.6 million people have succumbed to the disease. The United States remains hardest hit and is approaching the twin grim milestones of 16 million infections and 300,000 deaths. India, Brazil, Russia, and France make up the top five, with the US now very much the epicenter. South Africa is thankfully down to 18th in terms of recorded cases. The measures taken to limit the spread of the coronavirus seem to have borne fruit in most of the countries faced with a second wave. The two notable exceptions are Brazil and the United States, with the latter paying a particularly high price for the lack of a coordinated federal response to the disease. Yesterday, more than 230,000 new infections were recorded, and more than 3,000 people succumbed to the disease on the day alone. Thanks to a slowdown in the infection rate, the mortality rate in most hard-hit countries is also dropping off. The most glaring exceptions are the United States, Mexico, and Germany. On Wednesday, German Chancellor Angela Merkel pleaded with her countrymen and women to comply with lockdown measures in an emotional televised address. This week, Britain started a COVID vaccination program, and the United States should follow suit soon. The Electoral College will officially elect Joe Biden as America's next president on Monday, and the new stimulus package might soon be passed by Congress. Although economic data still point to a recovery in the US, job numbers disappointed last month. China has meanwhile piled additional tariffs on Australian agricultural exports. According to the OECD's latest projection, the world's economic output should be back to pre-COVID levels by the fourth quarter of next year. If vaccination is widespread and effective, this could occur as early as the middle of next year. But if the virus mutates and mitigation efforts are bungled, the status quo ante may only be restored late in 2022. The blue dots on this infographic depicts this year's projected GDP growth in various countries and economic blocs. The red triangles last year's number, and the green bars the forecast for next year. The message is clear. China and India will lead the world out of recession, and the US will lag the world average, the Eurozone average, and the average for developed markets. Relations between China and Australia have been in a downward spiral since April, when Canberra infuriated Beijing by suggesting that Chinese negligence allowed the coronavirus to spread internationally. China has retaliated by slapping tariffs worth billions of dollars on a number of Australian exports, including beef, barley, and wine. China is Australia's biggest trading partner, and the tariffs come at a time when the country needs a market for its growing agricultural output. Global equity markets have enjoyed another good week, and a number of US indices have reached new highs. The S&P 500 has now reached its third highest price-to-earnings ratio in history. This comes on the back of ever-improving US corporate earnings. The deadlocked UK-EU talks have weakened the FTSE and the pound, while the dollar is also on the back foot. Commodity prices keep rising while bond yields remain negligible. The ratio between share prices and corporate earnings is a popular measure of how expensive shares or markets are. The average PE ratio for the S&P 500 index in New York, the dark blue line, is way above its historical average, but it has come down significantly thanks to higher earnings. Using the same metric, we can see that emerging markets, the green line, are also becoming expensive, but that European markets, the golden line, are not expensive at all. The US dollar is going through an extended period of weakness. This graph depicts the greenback's performance in recent years. The green line represents the dollar index, i.e. the dollar exchange rate against a basket of global currencies, and the dotted blue line, the dollar versus the euro. In both cases, the dollar has depreciated sharply since the beginning of the COVID-19 pandemic. The news that COVID-19 vaccines are on their way has caused widespread optimism on global markets. This is also true of commodity markets, where the prices of all industrial commodities have risen quite sharply in recent times. This applies equally to coal and oil, the two laggards in recent months, and even to gold. Global equity markets have risen sharply since May, but still offer value given the synchronized economic recovery forecast for next year. Emerging markets should benefit from rising risk appetite and higher commodity prices. Listed property is starting to offer value, but bond and cash yields are unattractive and will probably remain so for some time. Locally, COVID-19 is unfortunately starting to dominate the news again. One of the key drivers of its resurgence is so-called COVID fatigue, which has led to widespread non-compliance with mitigation measures like social distancing and the wearing of masks. Matric rages are prime examples of super spreader events. In years gone by, parents used to worry about alcohol poisoning, STDs, and unwanted pregnancies. Now there's COVID as well. As of last night, nearly 840,000 South Africans have tested positive for COVID-19, and nearly 23,000 people have succumbed to the disease. More than 8,000 new cases were recorded yesterday alone, along with 173 deaths. The country is grappling with a second wave of the virus, and although government is understandably reluctant to impose measures that harm the economy, a return to some form of lockdown cannot be ruled out. The economy recovered faster than expected in the third quarter. Consumer spending, exports, and bumper crops boosted growth, and the low level of inventories augurs well for industrial output in the coming months. Economists caution, however, that consumer spending has probably plateaued and that the second COVID wave will impede the upswing. Fortunately, the global environment is benign and core inflation under control. The strong economic growth of the third quarter was broad-based. Primary industries like mining and agriculture made the biggest contribution, with an annualized rise of over 170%. Manufacturing and construction were not far behind, but the services or tertiary sector was more subdued. Despite the economy's strong rebound in the third quarter, we are by no means out of the woods yet. In real terms, in other words, if one excludes the effect of inflation, our gross domestic product is still 6% less than a year ago. South Africa's trade balance kept on improving last month. On the one hand, our exports, represented by the black line, kept rising, with strong contributions by mining and agriculture. On the other hand, imports, that is the green line, remain subdued, thanks to weak consumer demand and a strong rand. The JSE All-Share Index is back above the 59,000 level, and the good news is that it's not all due to Naspers and Prosus. Banks have been the stars of the show in recent months, but still have some catching up to do. Company results are steadily improving and the rand and bond yields remain firm. Prosus is now officially a European heavyweight, and Impala Platinum is reducing its debt. Compared to its long-term average, the JSE is cheap at the moment. With an average price-to-earnings ratio of 10, the all-share index is more than a standard deviation below its long-term average of 15. Relative to the PE ratio of the MSCI World Index, the ALSI is nearly 2 standard deviations below its long-term average. Equity markets try to anticipate what conditions are going to be like 2 to 3 quarters into the future. One of the key determinants of share prices is the expected growth in earnings per share. According to most estimates, next year will see much improved earnings by JSE-listed companies, with the resources sector expected to enjoy the strongest growth of the three macro sectors. Last week, foreigners were net sellers of South African equities, with nearly 15.5 billion rand flowing out of the JSE. Bonds, on the other hand, attracted net buying to the tune of 5 billion rand. The rand and the bond market are enjoying a symbiotic relationship with a strong exchange rate and attractive bond yields mutually reinforcing. The rand has been steadily gaining ground against the US dollar for the past 8 months. While dollar weakness had a lot to do with this, the rand has certainly fared better against the greenback than, for example, the Russian ruble, the Brazilian real, or the Turkish lira. Yesterday, the rand breached the 15 rand to the dollar level, and it is currently trading at 15 rand exactly to the dollar. Looking ahead, we need to remind ourselves that the JSE is effectively flat for the year. If earnings recover next year, it should boost the equity market. Whether earnings will keep on growing beyond merely regaining their pre-COVID levels remains to be seen. Nevertheless, the outlook for the JSE is improving and downside risk is diminishing. Compared to either developed markets or our emerging market peers, the JSE is certainly cheap. The AdviceWorks PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your AdviceWorks financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.